this chart here is basically what convinced me to buy gold. I went, oh my God, we're so overvalued with stocks, and gold is so cheap. So this is the reason that I got involved in all of this. The Dow has been crashing since the year 2000, measured in gold. You think the Dow is going up, that the stock market is going up. Well, it's not measured in gold. So now the market is not going up measured in gold. And we've had such a great return in the last year and a half on gold that it should be. Are you looking at the Dow gold ratio now, Alan? I see you.
Yes, I am. I'm trying to dig up some things on my computer. I was just working on the Dow gold ratio today. So I put this chart together, and we're in the 12s with yesterday's numbers, right? I didn't update it with today's close. But as of yesterday, the Dow gold ratio is 12 point something.
Wow.
And and going back here, this is a logarithmic chart, so it's a little hard to interpolate here. But if I remember, this was about 22. This peaked at about 22. Yeah. So gold has outperformed the Dow by almost a factor of 2 in like the last 5 years. So
yeah, okay, ever since gold bottomed and started coming back. So, I want to point out to everybody, this is probably annual data or monthly.
This I think is daily data. Yeah, this is daily.
Well, the ratio in 1929 was 18, not 15 or 14. Because it was a breath away from the Dow was a breath away from 400 points. It was 390 something, and gold was fixed at $20.67 an ounce, and then the Dow fell all the way to 40.22 points in 1932. And so I don't think that is not intraday data. I know that, but anyway. So it went, the bottom in 1932 was a ratio of 2 ounces of gold equaled the points of 1 share of the Dow. In 1980, it was gold and the Dow were $873 and 873 points at the same time. That was an intraday high. And so it was a ratio of 1. And so when it's further out of whack to one side, when it overshoots, it's going to go further to the other side. Now, that didn't go right along with a shift in the world monetary system. I think that it's very possible that we could be seeing gold's price at double the points of the Dow. If it's because of gold going up, that's great. If it's the Dow going down, a lot of people are going to suffer a lot, but I have a feeling it's going to be a combination, because that revaluation that was going on of the stocks versus gold from 29 to 32, that is only that's only the stock market moving. Gold was $20.67 an ounce. The revaluation from 71 to 1980, that is pretty much gold moving and not stocks. The Dow hit its head on 1,000 points in 1966, and it chopped. So it did go up and down. That big jag in the middle is actually a bear market in gold and a bull market in the Dow and S&P from, I think, it bottomed at the end of 74 and then went up throughout 75. I think that's what that jag is in there. So they're both moving. But basically, the Dow hit its head on 1,000 points and couldn't break through until 1982. That whole line falling there is pretty much gold, going from $42.22 to $873, down to just 1 ounce of gold equaling the points on the Dow. And now we have both of them moving simultaneously, and that is a magnifier. And I truly, so we're at how many? You said 12?
Yeah, about 12.6, I think. Yep.
Okay, so you should be able, if you're in gold right now, so this is gold, not silver. If you're in gold right now, and it does go down to 1, you're going to be able to buy 12 times more stocks with your gold. If it goes down to a half, it's 24 times more stocks. And that's from where we're at right now. I've been riding this ever since the peak. And this chart here is basically what convinced me to buy gold. I went, oh my God, we're so overvalued with stocks, and gold is so cheap. So this is the reason that I got involved in all of this back in 2022. 2002. Sorry.
2002. Yeah, that makes sense. Yeah, this is one of the more convincing charts for me as well. When you taught me about wealth cycles, and the Dow Gold ratio is like one example, because it's like, we know the dollar is phony baloney, like it's voodoo. It is. We know it's a terrible measuring stick. So if you're, curious about the price of gold measured in dollars, that's half nonsense, right? It's just pay attention to how many ounces of gold you own. Similarly, how many shares of stocks do you own? And then, you ride out the volatility measured in dollars. But if you want to, build your wealth over time, you just cut out the middleman, the voodoo dollar, and just, look at these two assets compared to each other. It makes so much sense to me. And then you just be patient, because these swings take a couple decades to play out. So you just stock up on one, no pun intended, but you stock up on one of the assets, wait a couple decades, and then transfer it into the other and stock up on that other asset. So it seems like such a foolproof, easy, low stress, easy way of investing. So I'm super thankful you taught me about it, Mike.
Well, thanks. You can see here also that there's sort of an equilibrium where they're both in fair value to one another. If you look at 1910, 1920, between like 2 and 4, or maybe even 5, somewhere in the middle of this whole thing. And so it shows that we're still in a hyper bubble with stocks, and gold is undervalued. And this is one of the things. Gold has been taking a run from 250 all the way up to 3,100 at this point. And a lot of people are going, oh, I missed it. In my opinion, nobody missed it. This is still one of the greatest opportunities in history. I've often said there are these rare moments in history where the safe haven asset, the place that everybody runs to in times of crisis, becomes not just the safe haven, but also the asset class with the single greatest potential gains in purchasing power. This is where we are right now. That's where we are. And so I hope that more people, but I've been hoping that for a long time.